Hey guys, Max here, and this is your daily update for yesterday, the 2nd of February. It was an interesting day to say the least. Markets were alright, but there was a poor end to the day as earnings came out from a few companies and it left some room to be desired. We also got a few updates on the US economy, the situation in Ukraine, so let's just get right into it. Now, while markets were open and before earnings from those companies came out, what happened? Well, US equities rose across the day. Nothing incredible, but a solid 0.9% for the S&P, 0.5% for the Nasdaq, and 0.6% for the Dow Jones. Across the rest of the world as well, equities did rather well. The Stoxx 600 was up 0.4%, the Hang Seng Index was up 1%, but the Nikkei was actually down 1%. Now, there wasn't actually any specific good news that caused those rises. This is mostly just leftover momentum from the confidence that markets have gained over the last week. Of course, this comes from the Fed's damage control. All 6 Fed officials who have spoken so far have said that a 0.5% interest rate hike is unnecessary. They've all been trying to calm markets down, and they've mostly succeeded. This day of gains means that we've now had the largest 4-day rally since 2020, which is definitely welcome for a lot of people after the awful month that January turned out to be. Even with this newfound bullishness though, the declines from January have still not been erased. The dollar had another slightly bad day, losing 0.2% against a market benchmark, and the 10-year Treasury yield actually fell down to 1.78% as well. Gold found some support at $1,800 and actually rose a little bit, now sitting just above that figure. Oil prices are still very high and people are concerned they're going to continue to rise as well. Right now, WTI crude is sitting above $88 a barrel. The crypto markets haven't fared quite so well though. Of course, they don't stop trading at the end of the day, so when these poor earnings came out, they saw some impacts as it was hurting some investors' risk sentiment. Bitcoin is sitting just a touch below $37,000 as I make this video. Ethereum is sitting above $2,600. Most altcoins for the day fell between 3 and 10% as there are just a few more worries emerging, and crypto is of course crazy volatile. Now, as for the rest of the week, it is Thursday, which means that the Bank of England decision on interest rates is going to be coming through. And it's probably going to be a small interest rate hike, which would be nice to see as inflation is getting a little bit too high for comfort over here. Now, I doubt it will be anything like a 50 basis point rise, but it will be the second rate rise in just over 3 months, so a sign that the central bank is concerned about fighting inflation. Now, I have mentioned this just a little bit in the past, but the UK government has inflation-linked bonds or gilts, basically government debt that rises in line with inflation, not interest rates, so it's far more important from the UK's government point of view to keep inflation from getting too high, at least compared to the US. Now, there were a few developments regarding the economy that we saw yesterday, and the first one is surrounding the jobs report that we're due to get this week in the US. Now, the consensus estimate right now is that the US has added about 150,000 jobs in the last month, which is a far lot less than the 500,000 a month that the US was hoping to make. To make matters even worse, some estimates have the data looking far worse than that, with one predicting a 400,000 jobs loss over the last month. Now, if that is the data we see, then that's a pretty huge loss, and it's really some bad news for the US economy. Somehow the Fed would probably still find a way to make the unemployment rate drop with this bad news, but the reality will be looking far more pessimistic than most people had been expecting. Of course, unemployment rates are low, but they're a very artificial figure and one that doesn't really mean a whole lot simply because of the way it's calculated. The most important figure to look out for is the labour force participation rate, basically what proportion of the population is actually working, and despite the fact that unemployment rates have been decreasing, they've been getting better, the participation rate has been decreasing, which means it's been getting worse. Now, if there are 400,000 job losses over the last month, then I really doubt the other data points are going to be looking any good either. To be honest, I think 400,000 is probably a bit steep and it probably won't be that bad, but net losses for the month is looking very likely right now. We will, of course, find out on Friday. The party line across the board here is that this is the fault of the Omicron variant, that it is too scary and it's forcing people to live at home in fear, but I just don't believe that, and there isn't really any data to suggest that either. I said the same thing about the Delta variant months ago, and it's now happening with Omicron as well. Those who are in charge, but also those who are reporting on this data, they're trying to mask the real state of the economy, and they're seizing the opportunity that new variants are giving them. Now, the next thing we've seen is more evidence to suggest suggests that inflation is here to stay and that these higher prices are not going to go down. We're not going to be seeing deflation anytime soon. Now, this refers to rising inventories in the US. The GDP figures we got last week showed a huge boost from companies buying up stock in advance to try and get ahead of the inflation that they're expecting. Now, the problem here is that the idea that companies are spending loads on inventory would suggest that in the future they'll spend less on inventory, but the data might suggest the opposite. Despite the fact that inventory buildup is increasing, inventories themselves are still at record lows, suggesting that these price pressures are going to continue into the future. Now, there is a great Bloomberg opinion article that covers this actually, and I'm going to link it down below in the description. It is, of course, on my Patreon as well for anyone stuck behind a paywall. Now, of course, inflation is high already, but those who have caused the inflation are still trying to defend their failures, most recently with Janet Yellen, who has claimed that Biden's huge spending bills didn't affect inflation at all, and that it didn't even cause inflation, and that nothing is her fault, of course. She's now defending her use of the word transitory by trying to change the definition of the word. She's claiming that we simply misinterpreted what she was saying, and that she never thought inflation would have died down already. Funnily enough, she's also predicting that inflation will be sitting at a modest 2% by the end of the year. No doubt though, when that time comes and goes and inflation is still far higher than that, she'll simply try to rewrite history again. She is obviously utterly useless. She's been wrong at every possible opportunity over the last 2 years, but she now expects us to believe her when she says that she's going to be right this time. Now, let's not forget that the US isn't the only place with soaring inflation, as Europe had its inflation data come through, and the headline from Bloomberg is absolutely ludicrous. It reads, Eurozone inflation unexpectedly hits record. Why? Why do they insist on doing this? I literally don't know. Just 1 month ago, when inflation data for Europe came out then, they did the exact same thing and claimed that high inflation in Europe was unexpected and a shock. But we've been talking about this for months now, and I don't understand why people let Bloomberg get away with this. They've done it constantly over the last year. They manipulate public opinion by gaslighting people into thinking that this is a surprise. It isn't a surprise, and if you are surprised by it, then you either just haven't been paying attention, which is fair enough, not everyone does. Or, if you have been paying attention and you're still surprised by this, you're an idiot. Now, Bloomberg journalists obviously are paying attention, which leaves only one possibility. Anyway, as for the actual data, quelle surprise, it's bad. CPI data across the entire Eurozone jumped up to 5.1%, the highest it has ever been in history. Lagarde, the most useless woman in Europe, has of course been adamant that there will be no rate rises in 2022 because inflation isn't real. She is, of course, wrong, and increasing prices are here to stay. Markets are now pricing in 1 or 2 rate hikes in 2022, small ones albeit, but some action nonetheless, although the ECB, the European Central Bank, is still adamant that they're right, everyone else is wrong, and all will be fine. Now onto corporate earnings and what might be about to shake the markets once more. We have Meta's or Facebook's earnings for the last quarter, and it wasn't good. Now, the first thing we saw was that Facebook spent $3.3 billion on development for their metaverse, which is a little bit worrying for a few reasons. Firstly, that's far more than anyone really thought they were going to be spending on it. It's also not really got them anywhere yet, so it seems a little bit like money down the drain so far. There are also loads of concerns about the metaverse in general. I personally think it's almost entirely a gimmick and a bubble, and we're 30 or 40 years away from augmented reality or virtual reality being good enough and seamless enough for this to actually be a strong industry. Here's the really important thing though. The metaverse already exists, you just don't call it the metaverse. Anything that allows you to connect or associate with someone who isn't actually there in front of you is part of the metaverse. The biggest companies right now in that regard are mostly social media, Facebook and Instagram type things. Then we have companies like Zoom or Discord that again allow people to seamlessly communicate with people online. There is no tangible benefit to looking at a computer screen and seeing 5 artificial characters with your friends' faces plastered on top of the characters on the screen. Compare that to just a simple Zoom call or a Discord chat, and it's actually a far worse idea. But right now, that's basically what the metaverse amounts to. It's a bubble, it's a gimmick, and it isn't going to go anywhere for decades. The thing is here, Facebook is a toxic name. It's a company that is hated all over the world, and Meta is an attempt at rebranding, at just tricking people into thinking that it's not Facebook anymore. It's Meta, a new company that doesn't have an awful history of selling your data and lying to government officials. $3.3 billion is too much to spend for that rebranding though, especially if that's $3.3 billion every quarter. Other than that though, Facebook just made less money than they expected. $1 to $3 billion less than expected in revenue. It isn't seeing growth anymore. There was no increase in users on Facebook. They are claiming that their ad revenue is being hit by firms not wanting to advertise due to high inflation, but Google saw the exact opposite happen, so maybe advertisers just don't want to work with Facebook anymore. There are also problems with Facebook not being able to gather as much data as it used to, as it's now an opt-in feature on iPhones rather than an automatic one. Earnings per share targets were missed as well, coming in at $3.67 versus the expected $3.84. In short, Facebook isn't doing too well, and investors, rightly so I might add, aren't convinced by the meta direction they're heading in. It's untested, it seems ridiculous, and certain elements of it, like the customizable avatars that Facebook are claiming are game-changing, well, I distinctly remember messing around with them as a kid on my Xbox, making an avatar once, and then never ever thinking about it again. It's just a crap idea. Again, the metaverse already exists. Facebook isn't creating it, they already did create it 10 years ago. It is already profitable as well from companies like Zoom and Facebook. It's just about making it easier and more efficient to communicate with people who aren't really there in front of you. The overarching problem though is that Facebook or Meta here, they aren't making things easier. They're making things harder, they're complicating things, and that's why it isn't going to work out. When it comes to the metaverse in general, think about this stuff critically. Don't get drawn in by the hype. Look at these sort of things that were tried in the past and how no one cared about them back then. Until the kind of augmented reality that we see in sci-fi films become a reality, where we have holograms sat in chairs across from us, the metaverse is a whole load of nothing, designed purely to distract investors from Facebook's toxic reputation, and the fact that crypto bros especially have jumped onto the hype train should be a warning sign of the fact that it is just all hype. Now, Meta's company share price has fallen 23% pre-market, which means $180 billion of wealth has just been disappeared. That's a damn big figure, and it threatens to derail the Nasdaq's recovery. Now, on top of that, some other earnings came out as well, and they weren't too good either. Spotify shares fell 23% in pre-market trading as well, as they didn't have as many total users or paid users as they had expected. They did still add 8 million new subscriptions and 25 million new users in the last quarter, so they're still growing, but they were priced as if they were going to grow far more. Now, I really don't think this is because of the controversy around Joe Rogan and that stuff. Neil Young, for example, probably generates something minuscule like a few $1,000s a month for Spotify, so him leaving the platform really isn't a big deal. Now, Spotify didn't give any real details into if this has been due to a drop-off in subscribers over the last 2 weeks, but I doubt there has, to be honest. They still saw 8 million new paying subscribers this quarter alone. Now, either way, like Netflix, growth has been slowing, so investors are repricing these assets and we're seeing declines. We then had Qualcomm release earnings, and it actually beat expectations across the board. Better revenue growth, better earnings per share, and stronger forecasts for the future as well. But probably on just bad sentiment for the tech market in general, the company lost almost 3% in value pre-market, as the Facebook tank has kind of scared a lot of people. Of course, we had PayPal fall yesterday over 24%. So it's looking like for tech right now, either you beat expectations by a really strong degree, or you take a 10% minimum devaluation, and there doesn't seem to be much space in between. Investors are worried about the outlook for these companies, so anything less than perfection is causing fears to emerge. Now finally, just a really quick update on the situation in Ukraine with Russia and tensions and everything like that. A few Royal Air Force jets were scrambled as some Russian bombers flew over towards our airspace, and there seems to be a bunch being made about this, but this really isn't any major news. This stuff happens constantly, and I mean literally constantly, something like once a month for the last 50 years. Basically, it's just Russia testing how quick our response time is for getting jets in the air, and NATO does the same thing as well, again, constantly, just testing Russia's response time. But because tensions are high, a lot is being made out of this on the news, but it's really not worth our time, to be honest. Now, Biden is running around trying to find alternate sources of natural gas for Europe. Of course, there's a shortage already, and most of it comes from Russia, so if sanctions or even war were to break out, energy prices are going to explode upwards, and so liquid natural gas imports and things are being considered to try and ease supply problems. Funnily enough, Biden is actually asking China if they can help, and I can't imagine that's going to go anywhere productive, but fair enough, at least he's trying to do something he usually doesn't. Now that is it for the day. We will be back tomorrow, of course, but I'm afraid I'm going to have to miss the day after. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. It is of course now February, so if you've been waiting to join, now is the perfect time. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.